Have you ever wondered why the stock market seems like this mysterious place where fortunes are made and lost every single day? Maybe you've heard people say things like, I doubled my money in Tesla, or the market crashed and I lost it all. And if you're new to this world, it can feel overwhelming, like you're stepping into a secret club where everyone else knows the rules but you. Here's the truth. The stock market is not magic, and it's not reserved for Wall Street experts. It's simply a marketplace. But instead of buying shoes, furniture, or groceries, people are buying and selling ownership in real companies. So let's start from the ground up. Imagine walking into the world's biggest auction house, but instead of paintings or antiques, the items on the block are pieces of businesses. Apple, Google, Amazon, Coca-Cola, Nike, and thousands more. Every single share that gets traded is a tiny slice of ownership in those companies. That's what a stock is, a piece of ownership. When you buy a stock, you're not just clicking a button on an app, you're literally buying into a business. Now here's where it gets interesting. The prices of those pieces are constantly moving. One minute, Amazon might be worth $130 a share. The next, it's $135, then back down to $128. Why? Because it's an auction. If more people want to buy than sell, the price goes up. If more people want to sell than buy, the price goes down. That's the heartbeat of the stock market, supply and demand. And all this action happens through something called stock exchanges. Think of them as the digital marketplaces where all these trades are processed. Some of the most famous are the New York Stock Exchange, NASDAQ, and the London Stock Exchange. When you hear people shouting on the trading floor in movies, that's the old school version. Today, it's mostly algorithms, apps, and computers doing the work in milliseconds. But let's pause for a second and answer a big question. How does a company even end up in this marketplace? Here's how it works. A private company, let's say a small tech startup, wants to raise a lot of money to expand. Maybe they want to build new products, open offices around the world, or hire thousands of employees. Instead of just borrowing billions from a bank, they can go public. That means they sell part of their ownership to the general public in exchange for cash. This process is called an IPO, or initial public offering. Think of it like Shark Tank, but on a massive scale. Instead of pitching to 5 investors in the studio, they pitch to millions of everyday people who now have the chance to own a piece of the company. From that moment on, the company's stock is listed on an exchange, and anyone with a brokerage account can buy and sell it. And here's the key detail. Once a company is public, it no longer controls its stock price. That power belongs entirely to the market, to buyers and sellers, to supply and demand, to confidence and fear. So, in the simplest possible terms, the stock market is a giant, never-ending auction where businesses sell ownership and investors trade those pieces back and forth based on what they believe those companies are worth. Okay, now that we know the stock market is basically a giant auction, let's zoom in on the star of the show, stocks themselves. So what exactly is a stock? A stock is a unit of ownership in a company. It's as simple as that. If you own a stock, you own part of a business. That means when you buy a share of Apple, you're not just betting on the iPhone, you literally become a part owner of Apple. It might be a tiny slice, but legally, it's ownership. Here's an easy way to picture it. Imagine a pizza. The whole pizza represents the company. Now cut that pizza into, say, 10 million slices. Each slice is a share of stock. When you buy one of those slices, congratulations, you own part of the pizza. You don't get to tell the chef how to make it, but if the pizza grows bigger or becomes more valuable, your slice grows in value too. Now let's put some numbers to it. Suppose a company issues 1 million shares in total. If you buy 1,000 of those shares, you officially own 0.1% of the entire company. It's not enough to boss the CEO around or redesign the logo, but it does make you a legal shareholder. But here's where it gets more interesting. Not all stocks are created equal. Companies can issue different classes of stock with different rights. Let's break it down. 1. Common stock. This is what most people own. When you buy shares on Robinhood, Fidelity, or any other brokerage, chances are you're buying common stock. With common stock, you usually get voting rights. You get a say in shareholder meetings, like voting on board members or major company decisions. Now, unless you own millions of shares, your vote won't swing the balance, but you do technically have a voice. Dividends, sometimes. Some companies share their profits with shareholders by paying out cash called dividends. Common shareholders may get these, but they're not guaranteed. Think of common stock as economy class on an airplane. You get to your destination, but you don't have much influence on the flight. Now, preferred stock. This is a different category. With preferred stock, you usually don't get voting rights, but you do get perks. Preferred shareholders are first in line when it comes to dividends, and if the company ever goes bankrupt, they get paid before common shareholders. Think of preferred stock like business class on a plane. You don't get to tell the pilot where to fly, but you get better treatment along the way. 3. Blue chip stocks. This isn't a separate category by law, but more of a nickname. Blue chip stocks are the big, stable, household name companies. Think of Microsoft, Johnson & Johnson, or Coca-Cola. They've been around forever, they usually pay dividends, and they don't tend to collapse overnight. If common stock is economy class, blue chips are like the safest seats on the plane, steady, predictable, and trusted.
4. Penny stocks. On the opposite end, you've got penny stocks. These are super cheap, often trading under $5 per share, and they usually belong to very small or struggling companies. Penny stocks are risky. They might skyrocket overnight, but they can also crash to zero just as fast. Think of penny stocks like riding in a tiny old car with no seatbelt. It might get you somewhere fast, or it might break down completely. So here's a question. Why would a company even sell pieces of itself to strangers? Why not just keep the whole pizza? The answer is simple. Money. Companies sell stock to raise capital. That cash can then be used to open new stores, launch new products, hire thousands of employees, or expand internationally. In other words, issuing stock is like fueling the company's growth engine. Instead of borrowing billions from a bank and paying interest, they share a slice of ownership with investors in exchange for cash. And when you buy that stock, you're not just throwing money at a lottery ticket. You're investing in the future of that business. You're saying, I believe this company can grow, innovate, and make money in the long run, and I want to be part of that success. That's what makes stocks so powerful. They're not just numbers on a screen. They represent real ownership in real businesses that shape our everyday lives. Now that we've covered what stocks are, let's answer the million-dollar question. Why do their prices move up and down every single day? At first glance, it looks random. One day Tesla is up 8%, the next it's down 6%. Amazon hits a new high, then suddenly drops after earnings. If you're new, it almost feels like stocks move on pure luck. But there's actually a logic behind it, even if it's messy. The short answer, supply and demand. Remember, the stock market is an auction. If more people want to buy than sell, the price rises. If more people want to sell than buy, the price falls. It's that simple. But the real question is, what makes people suddenly want to buy or sell? There are a few big drivers. Let's break them down. 1. Company performance. This is the most obvious one. When a company is doing well, profits are up, sales are growing, new products are crushing expectations, investors get excited. They rush to buy shares, and the price rises. For example, let's say Apple announces record-breaking iPhone sales. Investors see that as proof the company is strong, so demand for Apple stock goes up and the price follows. On the flip side, if a company posts weak earnings or reports losses, investors may lose confidence. Demand drops, people sell, and the price falls. Number 2, market sentiment. Here's where things get less logical. Sentiment is basically how investors feel. It's the collective mood of the market, and moods can swing fast. Maybe a popular news site runs a glowing article about a company, or maybe a CEO tweets something bizarre. Those small events can shift how millions of people feel about a stock. Positive buzz creates a wave of buying. Negative headlines spark a wave of selling. A famous example is Tesla. One great announcement about new technology and investors pile in. But one single tweet from Elon Musk, something as simple as Tesla stock is too high, and the price can plummet within hours. Number 3, global events. The stock market doesn't exist in a bubble. World events can shake it up in an instant. Rising interest rates. Investors worry borrowing will get more expensive, which slows business growth. Prices fall. Inflation spikes. Costs rise, profits shrink, investors panic. A war or political crisis. Markets around the world drop, even if your favorite company is doing fine. A pandemic like COVID-19. Entire industries collapse overnight, while others like Zoom or Amazon skyrocket. In short, the global environment creates waves that ripple through every company's stock price. Number 5, investor emotions, fear and greed. This one's huge. Beyond facts and headlines, markets are driven by pure human emotion. Fear and greed move prices just as much as performance or news. When greed takes over, people buy stocks simply because they see them going up. That rush creates bubbles. Prices climb higher and higher, sometimes way beyond what the company is actually worth. When fear takes over, people panic sell at the first sign of trouble. Even strong companies can see their stock prices crash just because investors are spooked. Think of it like this. If you've ever seen a crowd rushing toward a store on Black Friday, that's greed in action. If you've seen people running for the exits during a fire alarm, that's fear. Both emotions play out daily in the market. Number 6, expectations. Here's the tricky part. It's not just about how a company is doing today, it's about what investors think it will do tomorrow. If Netflix reports strong subscriber growth, but not as strong as Wall Street expected, the stock can drop, even though the numbers were objectively good. Why? Because expectations weren't met. In the stock market, perception often matters more than reality. That's why prices sometimes move in ways that don't seem logical at first glance. So to wrap this up, stock prices rise and fall because of supply and demand. But supply and demand are shaped by company performance, market sentiment, global events, investor emotions, and expectations. It's a mix of logic, psychology, and chaos, all happening in real time. That's what makes the stock market so fascinating. It's not just numbers, it's human behavior on display. So far, we've talked about what stocks are and why their prices move. But let's be real. You're probably wondering, how do I actually make money from all this? The truth is, there are 2 main ways investors earn money from stocks: capital gains and dividends.
1. Capital gains. This is the most common and the most talked about way to make money. Capital gains happen when you buy a stock at one price and sell it later at a higher price. The difference between what you paid and what you sold it for is your profit. Here's an example. Let's say you buy 10 shares of Tesla at $200 each. That means you've invested $2,000. A year later, Tesla's stock climbs to $300 a share. Your 10 shares are now worth $3,000. If you sell, you've just made a $1,000 profit. That's your capital gain. Sounds simple, right? Buy low, sell high. But here's the catch. Stock prices don't just move in straight lines. They zigzag. They go up and down, sometimes for reasons that make sense, sometimes for no reason at all. If you panic and sell during a dip, you might lock in a loss. If you chase a stock after it's already hyped up, you might buy right at the top and watch it fall. That's why capital gains can be powerful, but also risky if you're impatient or emotional. 2. Dividends. Now let's talk about the second way to make money from stocks, dividends. And honestly, this is where things get really interesting because dividends are a form of passive income. Some companies, usually large, stable ones, don't just keep all their profits for themselves. Instead, they share part of those profits with their shareholders. They literally send you a payment just for owning their stock. That payment is called a dividend. Here's how it works. Let's say you own 100 shares of Coca-Cola. Coca-Cola pays a dividend of about $1.84 per share each year, split into 4 quarterly payments. That means every year, Coca-Cola would pay you $184 simply for holding those shares. And here's the best part. You don't need to sell the stock to get this money. You can keep your shares and still collect the cash. Now, $184 might not sound life-changing, but imagine owning 1,000 shares instead of 100. That's $1,840 per year in cash. Imagine 10,000 shares. That's $18,400 a year. Some investors build entire portfolios around dividend-paying companies so that eventually their dividends alone can pay their bills. That's why you hear about people living off dividends in retirement.